Everyone's watching interest rates. Everyone's waiting for prices to drop. But while that drama plays out on the surface, a far more serious problem is spreading quietly from city to city across America. Homeowners with 780 plus credit scores, the safest borrowers in the country, are now defaulting on their mortgages at a rate that has surged over 300% in the past year. These aren't reckless buyers who overextended themselves. These are people who did everything right, and they're still going under, and it's getting worse. Foreclosures spiked 57% in a single month. In Lakeland, Florida, 1 in every 145 homes is already in some stage of foreclosure. Cape Coral, Jacksonville, Cleveland, and even Washington, D.C., which just saw the largest inventory surge ever recorded in that market after tens of thousands of federal workers lost their jobs, are all feeling the pressure. But here's what almost nobody is connecting. The force behind all of this isn't mortgage rates. It's what happens after you buy the house. The hidden costs of homeownership have now crossed $16,000 per year. Insurance alone is up 70% in 5 years. And Fannie Mae and Freddie Mac just quietly change the rules on what kind of insurance you're even required to carry. The reason they did it tells you exactly how desperate the situation has become. Let's start with the delinquency numbers, because they just came out and they tell a story the mainstream media is almost entirely missing. The Mortgage Bankers Association released their Q4 2025 survey showing an overall delinquency rate of 4.26%. That number alone isn't alarming, but what makes it different this time is that delinquencies rose across all 3 major loan types simultaneously: conventional, FHA, and VA, all 3 moving in the wrong direction together. FHA loans are getting hit hardest, with delinquencies at 11.52%, the highest since 2021. Intercontinental Exchange, one of the largest mortgage data firms in the country, has been calling FHA and VA delinquencies a canary in the coal mine for the broader market. But the canary has already died. Credit data from VantageScore shows delinquencies rising across every credit tier: subprime, near prime, prime, and even super prime. That 300% surge? It was concentrated among borrowers scoring 781 to 850, the very best. Think about what that means. A credit score doesn't measure your savings account balance. It doesn't account for whether your property taxes just jump $200 a month. It only tells you whether you've been paying your bills on time until now. And right now, people who've been paying on time their entire lives are hitting a wall, because everything around a mortgage payment got more expensive all at once. The Adam year-end report showed over 367,000 properties with at least one foreclosure filing in 2025, up 14% from the prior year. Bank repossessions, meaning the bank actually took the home back, rose 27%. But the annual figure undersells the real story. December 2025 alone saw filings jump 57% year over year, and January 2026 continued the trend. That's 11 straight months of annual increases, and the pace is accelerating, not slowing. Florida is ground zero. Lakeland holds the worst foreclosure rate in the entire country at 1 in 145 homes. But Florida isn't alone. Cleveland has the worst rate among metros over 1 million people, and the highest zombie foreclosure rate in the country, nearly 10% of foreclosed homes sitting vacant with no one maintaining them. Chicago led the nation in bank repossessions. Las Vegas is at 1 in 210. Manhattan hit a 15-year high. And then there's Washington, D.C. After 120,000 plus federal job cuts, housing inventory in the D.C. metro surged over 60%. The suburbs around Gaithersburg and Frederick saw unsold homes spike 68%. In less than a year, one of the most stable housing markets in the country became one of the most distressed. When people talk about the housing market, it's always mortgage rates and home prices. But the real crisis, the one pushing even financially stable homeowners past the breaking point, is the cost of keeping the house after you bought it. Zillow put the total hidden cost of homeownership at $16,000 a year, covering maintenance, insurance, and property taxes combined. Those costs have risen 76% since 2017. If your income went up 20% over that same period, you're doing better than most people, but your carrying costs nearly doubled. Eventually, that math catches up. The biggest driver is insurance. The Dallas Federal Reserve, not some random blog, released a study showing premiums are up 70% nationally since 2019. In Florida, the situation is on a different scale entirely. The average Florida homeowner now pays over $8,300 a year in insurance. In parts of South Florida, that figure reaches $15,000 to $22,000 annually. At least 10 insurers have either left the state or gone bankrupt since 2022, meaning not only are costs going up, there are fewer companies willing to cover you at all. Intercontinental Exchange found that homeowners in the highest insurance cost bracket are at least 22% more likely to fall behind on their mortgage. The Dallas Fed projected 203,000 additional mortgage delinquencies per year going forward, purely from insurance increases. So when you look at those foreclosure maps, this is the engine behind them. People aren't defaulting because they can't afford their mortgage. They're defaulting because they can't afford their mortgage plus everything stacked on top of it. It's not just insurance either. HOA fees in South Florida rose from $567 a month in 2019 to $900 in 2024. High-rise condos in Miami-Dade now average over $1,900 a month in HOA fees alone, essentially a second mortgage. After the Surfside structural reform laws, condo owners are facing special assessments that can run into six figures. HOA-related foreclosures nationally jumped 50% in 3 years. 7 of the 15 worst price decline cities in America right now are in Florida. This isn't just a market correction. It's the entire cost structure of owning a home in that state collapsing on people. On March 18th, the FHFA, the agency overseeing Fannie Mae and Freddie Mac, reversed a major insurance rule. Previously, borrowers with Fannie or Freddie-backed mortgages were required to carry full replacement cost insurance, meaning if your house was destroyed, insurance would pay to fully rebuild it. That requirement is now gone. Borrowers can use an actual cash value policy instead, which is about 25% cheaper. Here's the cruel irony. This only applies to conventional loans. FHA borrowers, governed by HUD's separate requirements, are completely locked out. The borrowers who need relief the most, lower-income buyers, first-time buyers, people with smaller down payments already crushed by rising premiums, get nothing from this change. And for those who do qualify, the trade-off is largely going unmentioned. An actual cash value policy pays the depreciated value of what was damaged, not the replacement cost. If a hurricane takes off a 15-year-old roof, you're not getting a new roof, you're getting what a 15-year-old roof is worth. The gap between what insurance pays and what rebuilding actually costs can exceed $10,000. Fannie Mae's own previous internal analysis warned that these cheaper policies could lead to incomplete repairs, increased debt, and home abandonment after disasters. What the FHFA has done is lower the short-term cost and shift the long-term risk onto the homeowner. The next major hurricane to hit Florida or the Gulf Coast will expose just how severe that trade-off is. Everything described above is already played out in Canada, and what's happening there is essentially a preview of what's coming here next. Most Canadian mortgages reset every 3 to 5 years. Roughly 60% of all outstanding Canadian mortgages, over 1 million fixed-rate loans worth $300 billion, were originally locked in when rates were 1 to 2%, and are now renewing at 4 to 5%. The average payment increase is 20%, with some borrowers seeing 40% or more. Near-prime borrower delinquencies surged 31% nationally, and 55% in Toronto and Vancouver. Equifax Canada described it as financial stress rapidly spreading from subprime into the established middle class. Canada's banking regulator warned that up to 150,000 borrowers may be unable to refinance over the next 2 years. You might say, that can't happen here because Americans have 30-year fixed mortgages. For most existing homeowners, that's true, but hundreds of thousands of Americans are already experiencing the same kind of payment shock. Homeowners who took out adjustable rate mortgages 7 to 10 years ago, when rates were low, are now facing their first adjustments. The 5-1 ARMs from 2016 have been adjusting for years. The 7-1 ARMs from 2018 and 2019 are hitting their first resets now. Intercontinental Exchange data shows 328,000 ARM borrowers have already passed their initial fixed rate period and are actively adjusting in a dramatically higher rate environment. Someone who locked in at 3.5% can now be sitting at 7% or 8% depending on their cap structure, a payment shock that many families simply cannot absorb, especially stacked on top of insurance increases, tax hikes, and HOA spikes all compounding at once. Meanwhile, new ARM usage just hit its highest level since 2008, with 21% of new mortgage originations now adjustable rate. Among loans over $1 million, nearly half are ARMs. These borrowers aren't choosing ARMs out of confidence. They're choosing them because it's the only way to make the payment work. That's not optimism. That's desperation in mortgage form. Housing affordability just hit its worst level ever recorded. The Atlanta Fed shows that 47% of median household income is now required just to own a median-priced home, well above the standard 30% threshold. The price-to-income ratio nationally sits at 5-1, essentially matching the 2006 pre-crisis peak. The National Association of Home Builders calculates that 75% of American households cannot afford a median-priced new home. Renting is now cheaper than owning in all 100 of the largest U.S. metros. The first-time buyer share fell to just 21% of all purchases, the lowest since tracking began in 1981. And the median age of a first-time buyer has reached 40, up from 28 in 1992. Home prices are already falling in nearly 100 metros. Austin is down over 23% from peak. Cape Coral down 20%. Oakland down 24%. For cities have completely erased their pandemic-era gains. Inventory is surging across the Sun Belt. Raleigh up 54%. Las Vegas up 43%. Miami up 40%. To be clear, this is not 2008. Total foreclosure volume is still 87% below the 2010 peak. Lending standards are far tighter. Most existing homeowners are locked into historically low 30-year fixed rates. But what we are experiencing is a different kind of breaking point, not a credit crisis, but a carrying cost crisis. The mortgage payment stayed the same, while everything around it kept climbing. And for a growing number of homeowners, even those with excellent credit, the total cost of ownership has crossed the threshold of what they can sustain. The longer carrying costs keep climbing, the more sellers will be forced to come down on price just to move their properties. The people who win in markets like this are the ones who understood what was happening before everyone else figured it out.